Hey guys, how's it going? It is Saturday, July 11th. It's Saturday, so obviously the markets are closed. And a user or a viewer had commented on one of my previous videos that they had owned shares of stock and that they had sold the covered call on it, but the stock blew past their covered call. And so their shares got called away. Now, along the way, they did collect premium when they initially sold that option, and then they collected the difference in stock appreciation between their cost basis and the strike price on their covered call. But in actuality, they were still bullish on the stock, so they did not want their shares to get called away, but they didn't know how to manage their position. So I'm going to make a video today to talk to you about that, because what you can do relatively easily is just roll out your option until the next week or 2 weeks or 1 month or a couple months down the line, however far out you want to go. So you will collect more premium when you roll that option out. And also, let's say you roll it out to a higher strike price and the stock reaches that strike price at some point and you do want those shares to get called away. Well, now you're also collecting more stock appreciation because you have a wider gap or a wider distance between the cost basis, meaning what you own the shares at, and what the strike price is if you're very bullish on the stock. So as an example, I'm just going to use AMD, and just to make it kind of a quick and easy example, I'm just going to round this up because AMD closed Friday at $55.88. Let's just round it up to $56. So let's just say you bought AMD at the end of the day Friday, right before the market closed, for $56 a share. So I'm going to write that here on the side here. So $56 per share. That's your cost basis. And of course, you're going to need 100 shares, right? Because for every option you buy or sell, it's always in lots of 100 shares. So we're going to say, for this example, that you own 100 shares of AMD at $56 per share. So you essentially have $5,600 invested in AMD stock right now. So now let's go to the AMD option chain. And let's say come Monday morning when the stock market opens, you want to sell a covered call on AMD now. You want to run the back half of the wheel. So we'll look at the options chain, and these numbers are obviously going to change when the market opens Monday because the market is closed right now, and these are reflecting Friday's prices right after the market closed. So let's just say you want to sell, you own the stock for $56 a share. You are considering the $60 strike price because that's a good ratio for you, meaning you're going to collect $57 in premium just for selling the contract. And then if AMD does go to $60 or above, you're going to collect the difference between your cost basis, which is $56, and your strike price, which is $60. So in theory, let's say on July 17th, because this would be a weekly option, I mean, we can select any expiration date. Doesn't matter. We can go 2 weeks out, 3 weeks out. We can go out all the way to January 2022 if we want. And just to give you an idea, the farther you go out, obviously, the more premium you'll collect. So for that same $60 strike price, if you were to go out all the way to January 2022, you would collect almost $1,300 in premium the moment you sold that option. But let's just make it a weekly option just to keep it simple. So let's say you want to sell this weekly option expiring next Friday at the $60 strike price. So I'm just going to highlight this in pink just so we kind of keep track of what we're working with here. So when you do that on Monday morning, you're going to collect $57 in premium. So you're going to add $57 total, not per share. It's actually 57 cents per share, but because you have 100 shares, you're going to have $57 because 57 cents times 100 is $57. So you're going to collect $57. And then let's just say when July 17th, when next Friday comes around, AMD is exactly at $60. And then that means that your shares are going to get called away, right? Because you're at or above your strike price. So at that time, you would collect $57 in premium. So I'm just going to put PR. I'm going to try and spell it out in this little space here. So premium. I know it's horrible. I'm writing with my mouse here. So $57 in premium. And then as for the stock appreciation, $60 minus your 56, which is what you own it at, right? That's what we said in this example, $56 per share. So you're going to collect $4, right? Because 60 minus 56 is $4 per share in stock appreciation. And you own 100 shares. So that means you're also going to gain $400, right? Because 60 minus 56 is 4 times 100 shares. So it's $400 in stock appreciation. So that means come Friday, if AMD goes from $56 to $60, you're going to collect a total of $457 between the stock appreciation and the premium, and your shares are going to get called away, meaning you will not have any position now on AMD. And some people may like that because some people may think $60 is the peak price for AMD and they think it's going to come down again. So it doesn't make sense to let a stock ride up to 60, ride back down to 57, ride up to 58, 57 again while you're holding it, because at the end of the day, if it ends up at 57 and you bought at 56, you're only $1 per share positive. The wheel strategy, you can essentially cash out at a peak or at a high price and then buy back in at a low price. So let's say the following week, AMD again drops back down to 57. Well, if you're still bullish on AMD, you could buy back in at 57, for example, maybe ride it back up to 60 and do the same thing over again. So you just run the wheel strategy over. But let's say you think AMD, maybe good news is coming out, maybe they're going to launch a new product. For whatever reason, you're still very bullish on AMD and you think AMD could be worth $65. But so if that's the case, then you don't want to sell it off at 60. You want to ride it up all the way to 65 or higher. So what I'm going to do is I'm going to delete this off so it's not confusing. And if you don't want your shares to get called away on July 17th, you can what we call roll the option out. So let's say you want to roll it out for another week. You're not bullish on it long term, you're bullish on it short term, for example. So what we can do then is, because we sold the 60 strike call for July 17th, we need to close out that position, right, to cancel out our position that's open. And then we're going to sell another position to open it back up. So let's say you collected $57 in premium, right? When you initially open this, as time passes, as we get closer to July 17th, this may stay the same. It may go down just from time decay. It's really going to depend on where the stock price is in relation to the strike price. It may even go up a little bit, but that's okay, because when we open up another position for the following week, the two should essentially cancel out and you should still get a net credit. So for example, let's just say that on July 17th, when this option is expiring, fast forward until the end of the week, this is only worth 50 cents per share. So it's worth $50, just for an argument's sake, just to keep the number simple. So that means that what you're going to have to do, so this is not going to apply anymore, right? Because we're not going to try and get our shares called away. We're going to try and hold on to the shares and roll them out to a higher strike price. So what we're going to do then is let's just say we sold this contract for $57, right? So initially we received $57 in credit, right? We're going to just put a credit here for selling that covered call initially. And then come Friday, if we fast forward, let's just say this is now worth $50 because the strike price is very close to the stock price, because the share price rose from about 55 or 56 close to 60. So it's being tested. So let's say we have to buy the option back at $50, right? Whatever this value is near the day of expiration, that's how much you're gonna have to pay to buy it back. So that means we're gonna lose $50, right? That's gonna be what we call a debit, because we have to pay to close that position. You sold it initially, so when you sell something, you get paid, right? But now you need to buy it back. So when you buy it back, obviously you owe money. But the nice thing is, just because time decay has happened, the difference is still positive. So you're still up $7 for the week on the trade. right? So you're still net $7 positive. Now that's great. If you're happy with that, that means you can just end it there if you wanted to, because that means you still get to hold your 100 shares of AMD, right? Because you closed out your option position, and you get to keep a little bit of profit for the week. You made $7. You don't get the stock appreciation, right? Because you haven't sold your shares yet. And because you closed out your position, it kind of wiped out some of your gains that you made all week long. So most people would not want to do this because there's potential for more money. You're leaving money on the table. So what you should do, in my opinion, and this is not financial advice, but this is what I would do, is you can close out this position, but then now roll it out to a later date. So let's look at the following week's option, which would be July 24th. And if you look at the strike prices, let's say we chose again the $60 strike price. If you look at the premium is much more, right? Because the further out in time you go, the higher the premium values are. So by closing out your initial position, in our example, you are net positive $7. But now, let's say we're gonna roll this option out to the following week. And let's say you wanna keep the same strike price. So you wanna go again with the 60 strike option here. So we're gonna sell this again. So what that means is now when we sell this option for the following Friday, we're gonna net positive $118 because that's how much they're paying us to sell that option. So again, that's gonna be a credit. So now what you have done is you've made money. You made $7 initially by opening and closing your first trade. And then by opening or selling your second covered call, you've also gained more credit. So now you're net positive. I'm just going to use a different color here. Let's use green. You're net positive $125 over 2 weeks, right? Because we did 2 weeks worth of trading now. So you're net positive $125, and that's credit for you. And you've given yourself more time now to hold onto the shares. Because maybe, let's say by the following Friday, July 24th, AMD ends up closing at 58. It retracted a little bit. So now you get to keep your full profit of $125, which is your max profit, and you get to hold on to your shares. So that's how you roll an option out to still make money, but just give yourself more time for that trade to work in your favor. Now, this all depends on if you want to or if you don't want to get your shares called away. If you want to get your shares called away, then maybe you don't need to roll it out and just let that option expire and let those shares get called away the first week. But if you do want to roll it out because you don't want your shares to get called away, this is the way to do it. Now, the other option is, let's say you're not happy with the $60 stock price. You want even more stock appreciation because you're really bullish on AMD. So you can actually roll it out to any strike you want. I mean, you could actually do a lower strike if you really wanted to, but if you're very bullish on the stock, let's say you want even more stock appreciation. So you could go all the way up to 65 strike. Now, I just want to clarify, this $125 in credit is just from your options. You're still going to keep or get the $400 in stock appreciation, right? Because this is the 60 strike. So you would still get the 60 minus 56, which is 4 times 100, 400. You still get the $400 of stock appreciation if on July 24th, your shares are going to get called away if your stock price is $60 or above. But let's say you want to give yourself even more room or possibly more gains in stock appreciation. So you want to roll it out to the $65 strike price. So you want to go up to 65. So as you can see, because we're further out of the money, the premium value is less. So I'm going to erase this because this $7 is not going to change. That's what you netted from your initial trade by opening and then closing that position. But now, let's say you want to go to $65. Well, now you're only going to collect $55 in credit. So you're still positive, right? Because before you collected $118, now you're only collecting $55 because you're at a strike price that's further away from the money. So your net credit just from the option side is going to go down, because now you're only going to get $7 plus $55, which is going to be $62 in credit total. So that's much less than the $125 we just showed. However, if AMD does get to 65 or higher, you're going to collect an extra $500 more in stock appreciation, because now the difference is $65 minus your cost basis of $56, right? And that is going to amount to $9 per share times 100 shares, which is $900. So in this scenario, you would collect a total of $962 if AMD were to rally all the way to 65 or higher on July 24th. And again, your shares will get called away. But you can keep rolling out until the end of time. Let's say July 24th, AMD does go to 65, but you still don't want your shares to get called away. We'll just rinse and repeat and do the same thing again, meaning close at this position, right? So what you would do is you would buy that call back, whatever the value is at the time, go to a later date, and then sell another call at another strike. You go to the $70 strike if you wanted to. And you're just going to repeat this process over and over again until you're satisfied with the premiums you're collecting, or until you finally want to let that stock go and just collect the stock appreciation and the premium. So the gamble with choosing a higher strike price is you get to collect less premium up front, but if the stock goes or to that strike price or higher, you're going to collect a total overall amount of money because you're going to get more money in stock appreciation. So in our example of the $65 strike, we're going to collect a total of $962 if AMD is at 65 or higher. If we stuck with our previous example at the 60 strike, we would collect less total money. Yes, we would collect more in upfront credit, but because that strike between 60 and 56 is only $4, we would only collect $400 in stock appreciation. So that total in our previous example was $125 in premium credit, because the net credit here was 118. So we're going to write 118 plus 7 is 125. And then the stock appreciation credit was only 400. That's only a net of 525. So you can see the trade-off you're making here is, do you want to collect more money up front in the options premiums and then less money in stock appreciation? Or if you go with a higher strike price, you will collect less money up front but more money in stock appreciation. So it all depends on how bullish you are with the stock, what stock price or how much profit are you willing to accept, and how badly or how not badly do you want your shares called away. So that's a very simplified way of how to roll an option. And you can do the opposite of this on the put side as well. Because if you have a put, let's say you have a cash secured put because you're opening the wheel and the stock price plummets, but you don't want to get assigned shares of the stock, you can do the same thing, but instead of selecting higher strike prices, you can select lower strike prices to give yourself more of a buffer so that your stock price does not get close to your strike price and you don't get assigned shares. And again, you can do that until the end of time as well. Well, I guess until the stock price goes to zero, and you will slowly collect a little bit of premium along the way too. Also, on the flip side, in terms of puts, the longer you roll out lower and lower, if you finally do get assigned, if you do want to get assigned shares of stock, you will get assigned at a lower cost basis, right? Because you kept rolling that option down, and possibly you kept rolling the strike prices down too. You don't have to roll the strike prices down, but you can, because like I said, if you do eventually want to get assigned shares of stock, you will get assigned at a lower cost basis than you initially would have. So I hope that clarifies things and answers a few questions that some people may have. As always, if you have any questions or if things weren't clear, leave questions or comments below. And as always, happy trading.